Welcome to today's deep dive. We're taking you straight into the fast-paced and honestly high-stakes world of day trading.
Yeah, it really is high stakes.
Right. Our source material today is Day Trading Strategies by Andrew Elder. And the mission for this deep dive is to completely bypass the Hollywood myths and extract the actual mathematical realities, the risk management tactics, and the psychological discipline you need to actually survive in the markets.
All without feeling totally overwhelmed.
Exactly. And to set the stage here is a massive reality check right out of the gate. Over 60% of market volume today is dominated by algorithmic trading. You are literally competing against supercomputers.
What's fascinating here is that reality completely shatters the illusion of day trading as some casual hobby. It is a rigid, serious business.
It's not a game.
Not at all. Just look at the capital requirements. Today, trade stocks in the U.S., the government requires a minimum of $25,000 in capital.
Which is steep for a lot of people.
It is. If you don't have that, there are lower barriers to entry, like the Forex market trading foreign currencies, which starts around $500. Or you could leverage options contracts. But regardless of the asset class, that professional business-first mindset has to remain exactly the same.
Okay, let's unpack this because protecting that capital is everything in this business. There is a strict, non-negotiable rule across the industry. Never risk more than 1% of your total capital on a single trade.
Right. And if you are a beginner,
Oh, yeah, that number drops to just 0.25%.
it sounds incredibly conservative until you look at the probability math. Let's say you have a trading strategy with a solid 35% hit rate.
Which honestly sounds pretty decent.
Yeah, but statistically, you still have a 91% chance of hitting a 10-trade losing streak.
Wait, 91%?
91%. If you're risking 2% per trade, 10 losses put you 20% underwater.
Oh, wow.
It's a massive hole to dig out of. That micro percentage risk is your ultimate safety net.
91%.
Yeah.
That seems incredibly high for a strategy that actually works a third of the time. But I guess that's where the human element comes in to save you from spiraling, right? Even Michael Jordan had bad days.
Exactly. You're going to have losses.
Surviving that inevitable losing streak comes down to qualitative risk. Getting enough sleep, exercising to clear your head, and absolutely never trading hungover.
Never.
You need a razor-sharp mind if you want to hold your own against those supercomputers. And speaking of going head-to-head with them, here's where it gets really interesting. Let's break down an actual tactic, the ABCD pattern.
Oh, this is a great one.
Take the real-world example of Ocean Power Technologies, or OPTT. They announced a $50 million deal.
Which is huge.
Right, that served as a massive fundamental catalyst. Following that news, the stock surged from $7.70 to $9.40.
That's your point A to point B.
Exactly. Amateurs see that massive A to B spike and immediately give in to FOMO.
And right at that peak at point B is where they get trapped. Amateurs see the green line going up and they buy at the very top. But you should never chase a stock there.
Because it's a trap.
Why? Because algorithmic trading is designed to trigger that exact emotional FOMO at point B to generate liquidity for institutional sell-offs.
I see.
The smart money that got in at point A is taking profits. You need the discipline to step back and wait for the resulting drop.
Which brings us to point C.
You watch for the price to establish a new floor, what we call support at point C. That is where you buy in anticipating the next calculated surge upward to point D.
So what does this all mean? Well, whether you are planning to set up a day trading account tomorrow,
Or you just want to be a smarter long-term investor.
right, understanding these mechanics is invaluable. Recognizing algorithmic dominance, respecting strict risk parameters, and managing your own market psychology are skills that translate to literally any financial decision you make.
If we connect this to the bigger picture here, it's a final thought to mull over. Technical analysis, like tracking our ABCD pattern, focuses on immediate price action,
The day-to-day stuff.
while fundamental analysis tracks massive global shifts like emerging technologies or central bank interest rates. If day traders are out there obsessively tracking the micro fluctuations of these charts every single minute,
Yeah.
how much of our macroeconomic future is already quietly revealing itself in the short-term patterns they trade every single day?